Well, just this past Wednesday, February 1st, the Fed hiked interest rates by only 0.25%, and that represents the smallest increase we've seen since the first one at the beginning of 2022. But the question is, what does it mean for your hard-earned savings? Well, to find out, stay tuned to this week's episode of the Retirement Income Source, where yes, it truly is all about the income. And welcome to this week's episode of the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host, Sarah Samuels. So what does this mean? Does this mean that the Fed believes they've tamed inflation? The fire is now put out? Does it mean they think that they're perhaps going to cause a recession and they don't want to do that? We've got lots of good stuff to talk about here today that our listeners and viewers want to know.
Absolutely, Dave. Well, first of all, it's great to be here with you and, of course, with our listeners and our YouTube viewers. So I have to ask, Dave, this news about the Fed only raising interest rates by 1/4 point, is this making your weekend better? Is your weekend going great now with this news from Wednesday, Dave?
Do you think I'm that much of a geek that makes or breaks my weekend?
Yes, absolutely.
Okay, maybe a little bit. Yes, I will confess I'm a little bit of a nerd. So it does make me quite happy. Yes, absolutely.
Yeah. So explain to us, Dave, why does it make you happy? Why is this maybe a good thing?
Yes. Well, because we've talked about in the past how it's like racing a sailboat, right? If you pull the sails all the way in to gain boat speed to where you think they have to be, you'll trim the sails too much and actually slow down the boat. So all good sailboat racers, Dennis Conner and the like, right, they know that you have to pull in the sails to a lesser degree and then wait and see how the boat reacts and maybe pull them in a little bit more and a little bit more. Do it in small increments. And my fear right away was the Fed waited too long raising rates and then they jammed up interest rates and they were getting too far ahead of themselves. And frankly, Sarah, I'm still a little bit afraid that the increases they've made so far could end up creating a recession before the end of 2023. Yeah. But I'm happy to see that at bare minimum they're starting to realize this and they're slowing down the rate of increase.
Now, do you think it would have been better, Dave, to have no interest rate increase at all, zero?
Well, I think they need to stay with it to a certain degree at this point. I guess I wish that they had slowed down a little bit earlier and gone to 1/4 point increases earlier. Because it's not just about the level of the interest rates, it's about the degree of the increase. And since you know now that I'm a financial nerd, I'm a geek, right? In calculus, we talk about going to the second derivative instead of the first derivative, right? And I know none of our listeners really know what I mean by that, but
I barely passed calculus, so you already lost me.
So yeah, it's interesting. We were talking about that recently. Wednesday, as you know, I was at an event, a conference, a speaker, a bunch of financial advisors, and I think even some of them, when I talked about first and second derivative, they looked at me kind of funny, right?
Yeah, not everyone has a master's of science in financial services.
That's right, but it's really not so much about the level of rates, it's about the rate of increase. That's a big deal. So just like with sailboats, it's not necessarily about where the sail is trimmed, it's about the rate of the increase and what can do to the acceleration, good or bad.
Well, speaking of acceleration, Dave, we have seen mortgage rates really going through the roof, especially within the last year. And we have a listener out in Florida who needs your help.
Out in Florida?
You mean in Florida,
right here in
our
Florida,
home
where we
state.
are?
Well, I'm trying to be inclusive, Dave, because not all of our listeners and viewers are in Florida.
Gotcha. Okay.
All right. So we have Valerie from Florida. And Valerie says, Dave, I want to buy a home, but prices are high. Interest rates are high. What should I do?
Well, it sounds, Valerie, like you don't have a home right now. So I'm going to assume, even though I don't know this, that you're a first-time home buyer. And, it's tough because I know rental prices have gone up a lot over the last year. And that's painful for a lot of folks. But also a mortgage payment has gone up even more, right? As you indicated before, Sarah, the interest rates on mortgages have really almost doubled over the last year, which means payments don't quite double, but payments have gone up by at least 50%, maybe more throughout that time. In a lot of areas of the country, like right here in Florida, right?
Especially in South Florida.
That's right. House prices are staying pretty stable. They haven't softened that much. So what's my best advice? Well, don't overspend. I know it's probably a personal goal. It's something you want to do. Don't overspend. I'd almost question, if you're a first-time home buyer, if you should wait until interest rates come down just a little bit. Because right now, you get a mortgage rate at a high rate with prices are high, and that's a double whammy. See, I don't mind you buying when mortgage rates are high and it's forced prices down, which has happened in some parts of the country, because then you get a good price. When rates come back down, you can refinance. But if you have high mortgage rates and prices are still high, well, then it's that double whammy. So I might almost encourage you to hold off and just rent for a bit longer, short-term leases, and wait for the rates to come back down. But if you're really hell-bent on buying, if you say that's something I want to do, then just don't overbuy, don't overspend. Be modest about it. Realize that your first house isn't your last house. It doesn't have to be your dream home, but be smart about it. In fact, in a couple minutes, Valerie, I'd like to talk more about some of the reasons why I think that's so important for younger folks.
Well, Valerie, I hope that helps. And if any of our other listeners and viewers out there have a question that you would like to ask Dave, all you need to do is email us at askdave@theRetirementIncomeSource. That's SOURCE.com. And you might just hear Dave answer your question on a future episode of the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with our host, Dave Scranton. And today we're talking a little bit about the Fed raising interest rates by only a quarter of a percentage point. So not too high. Seems like they might be readjusting their strategy there. But Dave, really, we were talking about housing, mortgage rates still through the roof. Valerie, our Ask Dave listener, she wanted to buy a house. Why do you not want to spend too much on a house right now, or really in general?
Well, especially, a younger person, time value of money, the biggest expense they could have in their lives is retirement if they're blessed to live long enough. Yeah. And it takes more money now than ever before to be able to retire. So you remember, Sarah, I had a story a couple episodes ago where I talked about first when I started my career, and I was trying to convince some of my young friends in the early 20s to put back then $2,000 into an IRA, an individual retirement account, right?
Right.
And I created this study where if I started putting the money in the individual retirement account between age 22 and 30, so I did it for 8 years, and then I stopped. And then my friend with whom I was speaking then started putting that money away at age 30. The question I had for that person was, how many years would you have to put that money away, that $2,000 a year, at the same rate of return, to at age 65 have the same amount of money I would have if I started at 22 and only did it for 8 years? Yeah. And do you know how many years that person would have to save if they started only 8 years later? What
was the answer?
The answer was, even if they saved all the way to age 65, for 35 years instead of my 8 years, they would never have as much money as me. Why? Because of time value of money. The money that you save and invest early on compounds and has the biggest effect over the long run. So you have to look at any piece of real estate you buy today and you overspend, that limits the amount of money you could put away into 401ks and other retirement plans, right? Yep. You have to look at it as, in economics, we call it lost opportunity cost. It's not just how much money that house might make in the future, but it's a lost opportunity cost of what I could have earned had I did something different with that cash flow. Okay. And when you understand time value of money, the most important thing you can do is get an early start on retirement. So again, one of the many reasons I think you shouldn't overspend as a young person on housing. But as you know, Sarah, most of our listeners and podcast viewers, right, are part of the income generation. Right.
Those nearing retirement, maybe 5-10 years, or even in retirement right now.
That's right. So coming up, we're going to talk about what you can do also with your real estate. So whether you're just an empty nester or whether you're just getting ready for retirement or recently retired, what are some things you should consider with real estate, and where are the places that inflation is having a bigger effect on your money versus a lesser effect? All that and more coming up in just a moment right here. I'm David Scranton with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the income.
Welcome back to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with Dave Scranton, and today we're talking about the Fed's recent moves, raising interest rates by just a quarter of a percentage point. Really doesn't seem to be having an effect on the mortgage rates, though. Mortgage rates are still really high. So, Dave, right before the break, I teased this story that I wanted to share with you about this couple that is a retired couple, right? They left their jobs back in May of 2021. They figured out it was actually cheaper for them to live on a cruise ship instead of having a mortgage on their house. Isn't that crazy?
It's interesting. It's you find it hard to believe, and I'm sure that's not a balcony room with water views, right? It's
Probably the
it's
lower level room, I would say, the
it's
more
an internal
affordable room.
Yeah, but still, even then, you think with the costs of cruises that wouldn't be the case. But I guess the cruise industry has gotten beaten up so badly with the whole pandemic that that the prices are down. If you plan in advance, you can get some good deals. I just think it'd be a little exhausting, though. Imagine going from one cruise to another to another.
Well, hey, if you like to travel, I think it could be a really cost-effective way to travel the world. According to their numbers, they crunched it. They figured out it takes as little as about 44 American dollars a day. So I don't know very many places where you can get by on less than $50 a day. So good for them. They've been to Italy, Canada, the Bahamas, and Singapore so far. So an unusual strategy, but that's one way to do it, right?
Oh, I guess you have to love cruising to do that. But even then, I can't imagine. I just do it in my head. 365 days, $44 a day. I've got to figure that's under $20,000, and it's hard to believe that that's actually cheaper than even renting. That you should be able to rent for something at that price level. But I think maybe these folks just decided, well, it's the same price and it's more fun, so let's do it.
Hey, I think it's a great idea. But, most of our viewers and our YouTube viewers and our listeners out there, they probably don't want to retire on a cruise ship. So what are some things they should take advantage of with the real estate market?
Yeah. Well, it's interesting. Once you become an empty nester, most people realize they don't need as much house as they had before. So if you live in a place where the values are still holding up pretty well, but of course we know interest rates have gone up all around the country.
Right.
It might just be a great time to say, maybe I downsize. Let me downsize a little bit, because it's when the market is and if the market's weak, it's when you want to sell and buy, because if you're buying up, you can sell at a lower price than you're buying a more expensive property at a low price, right?
Right.
But if you're buying down, then you want to do that at a stronger market. So certainly buying down can make some sense for somebody, especially if you have a mortgage payment, right? You have a mortgage payment, you don't want to take that into retirement. Now you can take the equity in your home, exchange it for a property in cash, and that's it. You're done. You don't have to worry about the interest rates or anything like that.
Yeah.
So that's common. And if you can't do that, maybe you're upside down in the mortgage, or for whatever reason you don't want to do it, then you have to think about rentals, whether it's renting out rooms, whether it's Airbnb, whether it's stuff like that.
Yeah.
Things that you can do to turn that negative cash flow drain into a positive.
Yeah, I think the answer is you have to get creative. Maybe not as creative as the folks that live on the cruise ship, but maybe get a roommate, or if you live in a nice part, like a vacation spot, right, in South Florida, for example, it could be a good opportunity to rent your home to people, to tourists. So I think it's a good idea.
Sure.
But Dave, let's get into our Ask Dave question.
Okay.
We have Michael from Massachusetts, and Michael says, Dave, I'm part of the income generation. Oh, Michael, thank you for being one of our loyal, longtime listeners and viewers. Yeah. I'm part of the income generation, and I know that inflation affects everyone individually, but what should I be paying close attention to?
Yeah, well, great question, Michael. And you're right. It first of all, it affects retirees a little bit more than younger folks, because younger folks often do have a mortgage payment. That's a higher percentage of their overall income than folks that are our age, right? Either we have no mortgage payment or it's a smaller percentage. Okay. So when you go to work and you get a pay increase, that pay increase helps, because third of my income goes to a fixed mortgage, but I get a pay increase on all my income, right? So sometimes inflation could help a younger person. As you get older, you don't have that much fixed debt, or you shouldn't, right?
Right.
So inflation has a bigger
Ideally.
impact overall, and then medical costs that go up at a much higher rate than the normal rate of inflation affect us more than younger folks, right?
Yeah.
But you also have to realize that, for example, there's a difference in goods and services. Like right now, we're going through a situation where the goods inflation has kind of gotten under control. Companies have managed how to get supplies less expensively, and they've managed that cost, right? Or they've just increased the supply of goods, so the price comes down. But services, it's not that way. In fact, recently we had a conference that I mentioned earlier, a conference that I was a presenter at just earlier this week at a very nice hotel in Florida, and they had scheduled, I'm sure, more than a week ago, more than a year ago, I mean. And interestingly enough, I looked at the room, and although they were picking up the tab, it was just about $200 a night. And I thought, wow, if we tried to plan our conference there next year, it would be more than double that.
Right.
So that's an example of where Service costs have gone up much more than goods. And Michael, that's another place where it affects retirees more because younger folks tend to buy more goods, older folks tend to focus on more services. So that's why I have no idea, Sarah, how that couple from Seattle got this great deal on the cruise ship, because the reality is that that is a service, right? So Michael, what do you do? Well, what it means is that right now, if you know that dynamic, you might need to say, okay, let me invest in goods where I need goods and hold off some expenses on services. Let me be self-disciplined so then I can spend money on services when those prices get more reasonable, because everything's part of a cycle. It's going to go round and round. And if you're trying to be prudent with your money, you want to spend in the places where you can get the best deals right now. And Michael, I want to talk about that more later on in this segment, about difference in goods and services.
Yeah. Well, Michael, we appreciate you writing into the show. And if any of our other listeners, our YouTube viewers out there have a question that you want Dave to answer, all you need to do is send me an email, askdave@theRetirementIncomeSource. That's SOURCE.com. And Dave might just answer your question on a future show. You're listening to The Retirement Income Source, where it truly is all about your income. I'm Sarah Samuels, and I'm here with my good friend, Dave Scranton. We're talking about inflation, the Fed's recent moves, plus this crazy story about a couple that managed to, they're living on a cruise ship in retirement for about $44 a day. So
God
good
bless 'em.
for them.
Yeah.
Exactly. But Dave, tell us, why does inflation tend to hit these retirees and to hit seniors so much harder? Is it really because of the fixed income? They're really living on a fixed amount of money each month?
Well, yeah, in part because you're living on a fixed amount of income, but also, as I said, because you don't have fixed payments going out the door. So all your payments are subject to inflation because you may not have a mortgage, or your mortgage is small relative to your income. That's part of it. Medical costs going up rapidly, like I mentioned to Michael. But you can do some things to try to combat that. And I'll be a little extreme here. But for example, at some point in the future, you might need to buy a new car, but you also want to do some traveling.
Okay.
Well, now that maybe the auto prices have gotten a little bit more in line, and I'm speaking out of school because I don't think they're really back in line, but the inflation on most goods has come down. So if you can get a decent deal on a car, you might want to buy that a few years early and get that expense done and save your traveling maybe a little bit later. Or maybe in your first couple years, travel by car. It might save you some money. It was a little less expensive. Even when it comes to things like RVs, right? People think, gee, I don't want to buy an RV. It's a big upfront
They think it might
cost.
be too much money, right? It's what, $200,000-$300,000 typically for an
Or
RV?
you could do it for $50,000-$70,000 if you're smart
A
about
used
it.
one.
Yeah, of course. But the point is, if you're going to stay in a hotel, you're going to stay in a used hotel room, right?
That's true.
So
Good point.
if the hotel room went from $200 to $400 a night and you plan to do enough travel, you may just say, it makes more sense for me to go out now and buy an RV and use that for travel. And that's not always the case. There are other times when it might make sense to just rent and be in the hotel. But this may be a time where going to the goods and service might make more sense. Goods might make more sense than actually the service. So again, just some thoughts here, and instead of, if restaurant costs have gone up, maybe instead of eating out as much, maybe now with the RV, you can actually cook in. You can't do that with a hotel.
That's right.
But it's kind of fun. You're cooking in the RV and you're eating outside, under the canopy. And if you've seen the RVs, the canopies that come out.
They're
you get to
beautiful
see-
these days. I've seen some. They look even nicer than some homes, honestly.
Yeah. So again, just pick your battles.
Yeah.
Be smart about it. Pick your battles. Do things where you can get a good deal, and where you can't get a good deal, then just postpone it.
Yeah. Well, it makes total sense, Dave. Well, a lot of people are thinking maybe the Fed went too far. Dave thinks maybe the Fed waited too long. So are we really going to be seeing a recession? Well, we're going to ask Dave to give us his best crystal ball recommendation next. I'm Sarah Samuels, and I'm here with Dave Scranton, and you're listening to The Retirement Income Source, where it truly is all about your income. Thanks for listening to The Retirement Income Source, where it truly is all about your income. I'm Sarah Samuels, and I'm here with our host and my good friend, Dave Scranton. So we're talking about inflation. We're talking about the Fed's recent moves. So recession, Dave. UPS is now predicting a mild recession for this year, saying that this year might be a pretty bumpy year, actually, due to these rising interest rates, some high inflation, that sort of thing. So what do you think, Dave? Are we going to have a recession this year? What's your best crystal ball prediction?
Well, I think UPS is a little bit late to the game here, because over 75% of all economists do think we're going to have somewhat of a recession at the end of this year or beginning of 2024. But to give UPS credit, they kind of know they're at a forefront there, so they see how much is getting shipped in terms of goods and services to an end destination. And when they see a slowdown on some of that commerce, they're in a great position to indicate, okay, what is happening here? But we talked earlier about how service inflation is high on services. Prices are still going up.
Yep.
And a lot of that's because of wages, right? Service inflation is high because, waiters, waitresses, cooks, they need more money because of inflation. So that pushes the price of the service up.
Yeah.
But goods inflation has come down, right? So it shouldn't surprise us that in order for goods inflation to come down, it means people are buying fewer goods, right? So there's fewer goods being shipped. So I'm not surprised that UPS is seeing this. The question is, what's going to happen here? Well, Sarah, that I was in the camp. I was on television back in 2021 saying, before the Fed started hiking, saying that, look, the Fed's going to hike. They'll probably create a recession. They've created almost as many recessions as they fixed, right? So they're like the arsonist and the fireman all wrapped into one.
Who caused this fire? Who did this?
So yes, I've always believed that we'll have a recession. I will tell you, the only thing that makes me a little nervous now, and you can relate to this, is that, usually in Wall Street, when everyone's on one side of a prediction, on one side of a trade, the opposite happens. So when everybody leans on one side and thinks the stock's going to go up, it usually goes down. When they think it's going to be down, it often goes up. So that's what we're up against right now. With all these economists, I am a little squeamish going out there and predicting it. But yes, if you hold my feet to the fire, and I know you're going to.
Yep, I always do, right?
That's right, you always do. You're very good at that. I would say yes, we are going to see some type of recession at the end of this year or beginning of next year. I think just based upon the interest rate increases that the Federal Reserve has already made.
Yeah. Well, it's not just you who thinks there might be recession, Dave, or the 75% of economists you mentioned. Consumers are actually really worried about this, too. Consumer confidence actually went down in January, 109 to 107. So not a big drop, but it did go down. So I think people are worried about this. If they're not worried yet, they're going to start getting worried.
Well, yes, they see it. And it doesn't help that even like we talk about how the media calculates inflation and how the Fed talks about inflation. They use that 6.5% number year over year as of the end of December. But as we talked about, really, if you look at the last 6 months of the year, inflation was at a closer run rate of 2% annualized.
Right. That number can be misleading.
That's right. So when they see that, the consumer thinks, oh, my goodness, the Fed's going to continue to raise interest rates even more. And yes, they will create a recession. But that's good. I think this consumer confidence index having gone down is going to help the Federal Reserve. Yeah. Because if people are a little less confident, they're going to buy fewer goods, maybe spend a little bit less money on services. That's going to help the costs go down without the Fed having to jack up interest rates too much further. So I was actually glad to see that report, Sarah.
Yeah. Well, one of our listeners, our viewers out there, he is not feeling very confident, Dave. He's part of these consumers that are not feeling great about what's happening right now. But we have Cameron from North Dakota, and he says, Dave, I think there's a high chance of recession. I need to know, how can I protect my money?
Okay. Well, Cameron, you're from North Dakota, so it's really simple. Just go ahead and take it and bury it in the ground. It'll be frozen 12 months a year.
You can't spend it that way if it's frozen,
It'll
right?
Be frozen. That's the solution. No, in all seriousness, this whole thing, we've always talked about these things called 60-40 portfolios. All these advisors, Cameron, seem to be out there for a long time now with 60% in stocks, 40% in bonds, maybe 70% in stocks, 30% in bonds. And lately there's been some conversation about the death of the 60-40 portfolio. And the reason is because most average advisors simply don't know how to get good yields in the bond market. They would tell you up till now, and maybe you heard this, Cameron, best you can get in the bond market's maybe 2%. Well, that's not necessarily true. We were getting 4% or more for our clients, pretty much even the lowest interest rate environment. But that was the thought that bonds are dead. And truthfully, with interest rates going up over the last year, it has created a headwind for bonds. Because as you know, Cameron, when interest rates go up, bonds come down. But now that the Fed seems to be close to the peak on interest rates, that headwind has ended. And bonds are paying a better yield now by far than they were a year ago. So if you want to protect yourself in times of recession, bonds are often the right answer because you lock in a good income. You have a par value, a date at which you're guaranteed to get all the money back from the issuer, your principal, provided there's no defaults. And if interest rates do drop, you may even see a paper gain in the price of your bond. Now, we'll talk more about this through the rest of the segment, Cameron. But again, simple answer is, if your advisor has not told you to look at bonds up till now, or you've not thought to look at bonds, now is the time you might just want to take a look and start considering them again.
Well, Cameron, thank you so much for sending in your Ask Dave email. And if any of our listeners or YouTube viewers out there have a question and you want to put Dave to the test, all you have to do is email us at askdave@theretirementincome.source. That's SOURCE.com. And you're listening to The Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with Dave Scranton, talking about the chances of recession. Are we going to see it or not? A lot of consumers are worried about this. Economists are predicting it's going to happen. So, Dave, you recommended getting into bonds because bonds do better in a recession. Is now still a good time? Is there still an opportunity to get into bonds now if you haven't already?
Yeah, and I think the timing is good. I mean, ideally, you want to get in at peak interest rate environment, right? But it's not that simple because it's not just interest rates based upon what the Fed is doing. You know, the market controls the long-term interest rates, not the Fed. So it's really based upon long-term interest rates. And it's even more complicated than the market because there's an interest rate for a AAA rated bond, which has very little risk of default. There's an interest rate for AA, single A, triple B, double B. Every different credit rating of bond, there's an interest rate for that bond. So whichever part of the market you're going to be on, you want to get in ideally at the highest point. But I think that one thing that a lot of people would agree with right now is the Treasury rates have come up. The Fed's probably going to stop raising rates at some point. So it might be a decent time to consider high-quality bonds, investment-grade bonds, especially if you're concerned about a recession and you're part of the income generation.
Right. And Dave, I know that we do, we as in Dave and all of our other income specialists that are part of the Retirement Income Source, you actively manage these portfolios, which is how we're able to get that 4% number. How do you know if you're working with someone that can get you bonds and not those bond mutual funds? Because there's some confusion between those two things.
And that's a great point. So it's important. Cameron, I hope you're still listening because Sarah brought up a good point here. You know, a lot of advisors are stock market based advisors. Why? Just because that's what they were taught to do. A lot of us that got in the industry from the 1980s and thereafter, it was all about stocks, and more stocks, right? So as a result, bonds were just an afterthought. And we were taught just to use bond mutual funds or bond ETFs in the bond market. And the problem is those guarantees I just talked about, Sarah, for individual bonds, they do not apply with a bond fund, right? With an individual bond, you get a fixed income, a dollar amount of interest for the life of the bond, right? And when the bond matures, assuming the issuer has not gone bankrupt or had a default, then essentially you get your principal back. So as long as no bankruptcies or defaults, you know exactly what you have. But Sarah, if you buy a bond fund or a bond ETF, both of those guarantees are gone. They're absolutely off the table. So you're taking more risk in a bond fund or bond ETF. In fact, if you were to study, to take the exam to become a financial advisor.
Which I'm thinking about doing, Dave, every day.
I'd love you to do it, actually, Sarah. I wish we had more ladies in our industry. I really, really did, and you're smart enough to do it. But if you were to study to take that exam, you'd learn that the definition of a bond mutual fund is really this. It's the stock of a company that owns bonds. So not only does it sound riskier, but now Cameron and all of our other listeners and YouTube viewers know that why. Because the two guarantees that attract people to bonds are off the table with bond funds. So if your advisor is recommending bond funds or bond ETFs, I would say that's the first signal that they're truly not an income specialist.
So, Dave, what if you don't want to gamble or speculate on, whether or not there's going to be a recession or if interest rates are going up or down?
Or whether you flat don't want to trust Dave Scranton's crystal ball, right?
That's right. Well, we're going to share some strategies that will protect you no matter what the Fed does or what the economy does coming up. I'm Sarah Samuels, and I'm here with Dave Scranton, and you're listening to the Retirement Income Source, where it truly is all about your income.
And welcome back to the Retirement Income Source, where it truly is all about the income. I'm David Scranton, here with Sarah Samuels, and we've covered a lot today, but we have a lot more to cover. So far, we discussed the Fed's quarter-point interest rate hike just in the middle of the week, last Wednesday, the smallest hike we've seen since the first one at the beginning of 2022. Also, the probability for recession, and we ended the last segment talking about where you could put your money in case you really are worried about inflation, and we discussed how the bond market is more opportune right now, paying more interest than, frankly, any time I've seen in more than 15 years.
Right. But Dave, what if people don't want to speculate? They don't want to gamble. They're really looking for some kind of strategy that's really safer and more reliable than the traditional growth investing. What can they do?
Yeah. Like I said, I mean, they flat don't want to trust Dave Scranton's
They
crystal
do not
ball,
trust
right?
Dave Scranton's
You think
crystal
we
ball.
might have a listener, too, that actually feels that way? Is that what's happening
We
here?
might have a couple out there.
Oh, my heart is broken. I can't believe it. Well, you know what? Guess what? You shouldn't trust Dave Scranton. You shouldn't trust anybody. You need to make decisions for yourself. But gathering information is important, and that's why I'm so glad that you're here listening to our show once again, because it's a great source for gathering information, even though it's not the only source. But so let me back up and talk generically,
Okay.
Sarah.
Yeah.
Because, there's the bird in the hand, there's taking winnings off the table, and then there's when you leave winnings back on the table, right? And whenever you can take winnings off the table, it reduces your risk. So think about it this way. We talked about real estate earlier, and we talked about how real estate prices are still pretty high in most parts of the country, but also mortgage rates are high, so it's kind of a double whammy if you're trying to get into real estate. But, the reality is that let's say you have a rental property, right?
Yep. Okay.
You have you can make money in two ways. You can make money on growth because the rental property goes up in value.
My building goes up in value over time.
That's right.
Okay.
Or you can make money through the rental income that you get.
Okay. So every month I get income from my tenants, basically.
That's right.
Okay.
So now you compare that to just buying some raw land, right? If the property values go up, okay, you're happy, but it doesn't matter that much because your rental income has stayed the same.
Yep.
With the raw land, you're really happy because it's the only way you're making money, right?
Right. It's good news now. I could sell it and make more money.
That's right. Conversely, if the value goes down of the rental property, now, okay, I don't really care that much because my rental income has stayed the same, assuming I have creditworthy tenants. But guess what? If the value goes down and I have raw land, now I'm really miserable because I'm gaining nothing.
Right. And I could even be underwater if I spent more money on my land than now what it's valued at. That makes sense.
So it's what you can take off the table in the form of income helps you de-risk. And if you ask any farmer, and I know a lot of you listeners live in areas of the country other than Florida, where maybe farming is bigger. Of course, in some parts of Florida, farming is pretty
Absolutely.
big.
Oranges, big time orange farming.
That's
here.
right.
But yeah.
That's right.
Yep.
And if you fly over, as a pilot, I'll fly over sometimes giving flight lessons, and you do see crops and things for sure. But in lots of parts of the country, people know that if you talk to a farmer about not farming the land, they're going to think you're nuts. They're going to look at you like you're crazy, right? And they really don't care about the value of the land. They care about the income from the crops. And the reality is, if the value of the land goes down, they're actually happy because now they can take the profits from the crops and they can buy more land to have more crops, right?
Right. It's kind of like your dollar cost averaging metaphor
That's
almost.
right.
Yeah.
That's right. But what it's doing is it's de-risking because they're getting cash off the property by working it. And the same is true with rental property, and the same can be true with liquid investments too. And I want to continue that conversation throughout this segment, actually.
All right. Well, first of all, let's get into our Ask Dave question before we continue that conversation, Dave. So we have James from Wyoming, and James says, what if I don't need the income from my investments right now?
Yep. Well, James, great question. It's a perfect segue into where we're going here, because the reality is if you don't need the income from your crops, then you do what that farmer does. You take that income, you reinvest it to buy more land. And in the years when the land prices are cheaper, you get to buy even more land than you do with that crop proceed, if you will, than the years in which the land is expensive. And that's what Sarah just mentioned, that concept of dollar cost averaging. Because you see, when you're younger, you might have a small amount of money, but you're putting away some money. So you have a big dollar cost averaging effect. As you get older, hopefully you've built up your nest egg. And now the amount you're saving every year is a smaller percentage of your overall nest egg. And as a result, you have a lesser dollar cost averaging effect. But if you invest in things that generate income, now you can accentuate that dollar cost averaging effect. Just like the farmer who's using the proceeds from the crops to buy more land will buy even more land when the land is cheap. And just like the person with the rental property, if they take the rental income and use it to buy more rental properties, when the property prices go down, they'll buy even more. They'll get their average cost down. So bottom line, if you don't need the money, investing for income can not only help you de-risk because you're taking some money off the table, but can also make you a capitalist. So now you're getting your average price down and you're taking advantage of the dips versus being a victim of the dips. So great question. I love that question, Sarah. Thank you.
Yep. Well, there you have it, James, and I hope that helped answer your question. And if any of our listeners, our viewers out there have a burning question, or you really just want to put Dave to the test, all you need to do is email me at askdave@theRetirementIncomeSource. That's SOURCE.com. You're listening to The Retirement Income Source, where it truly is all about your income. I'm Sarah Samuels, and I'm here with Dave Scranton. We've had a great show today covering a lot of different
But we're not
topics.
done yet.
We're not done just yet. That is very true, Dave. And I want to talk to you a little bit more about this idea of income and then transitioning to income. You've said recently in a couple shows, and I think it's worth repeating here, why is now a good time to maybe make that transition earlier than you were expecting to?
Yeah. Well, first of all, I want to make one thing clear.
Yeah.
You know, if you're not driving, I encourage you to write down this equation. I talk about it all the time, but it's TR equals I plus G. TR equals I plus G. So that's total return equals income plus growth. The formula for almost any investment is that the total return, how much money you make on the investment overall, is a combination of the income you receive through rental property, through crops, or in the case of financial instruments, through interest and dividends, as well as the gain. And Sarah, to answer your question, the more uncertain you are about the gain, right? Will we have recession? Will we not? Will the Fed start lowering interest rates and create another tailwind for financial assets, or will they leave them high for a while, right? So if you don't want to bet on Dave Scranton's crystal ball or anybody's crystal ball, then it's a great time to get into things that have income, because that income is that truly that bird in the hand. And like we said, reinvesting that income allows you to accentuate those dollar cost averaging effects, which really helps somebody become a capitalist. Because Sarah, what I hate is people when they have the victim mentality. And some people do it with their assets because they just don't know. But it's kind of like, oh, the market's down, woe is me. You know, you get your statement in the mail and you open up, you take a peek at it, it's down from the month before. So you tear the thing in shreds, you throw it in the trash, and you walk in the refrigerator and grab a beer or pour yourself a glass of wine, right?
Right, yeah.
Well, there's no sense to do that. For every bad news, there's an opportunity, right? You can always make lemonade out of lemons. And this is a great example where, I want people to be capitalists, whether the market's going up or going down. I want them to think about how they can make money. And right now, making that transition is pretty powerful, especially if a recession hits and the values go down. You'll be glad that you made that transition right now. Yeah. When the values are high, and you could maximize the I component.
Yep. Well, like you mentioned, Dave, you and all the economists out there are really saying we're heading towards recession. So it could be a good time now to really reassess that, and also to take a look at your risk tolerance, of course, too, and make sure that that's in line with everything, so you can feel comfortable. But bottom line, Dave, what is your best advice for our listeners and our YouTube viewers out there that are part of the income generation and they need that retirement income? What's your best advice for them?
Yeah, if you're part of the income generation, you definitely want to make that transition from the G to the I, the total return focus, to the income focus earlier, as much as 10 years or more. Now, that's something you're not going to hear from most financial advisors, because most financial advisors are retirement planners. They're really good at getting you up to retirement, but they're really not good at getting you through retirement. And that's a different phase, just like you have a pediatrician at one phase of your life, and then you have a primary care physician after that, and then eventually you might have a gerontologist if you get old enough, right? God willing. So making that transition from the G to the I, from total return focus to income focus, earlier than most people would think. And make sure that you're working with an income specialist. And Sarah, again, how do you know when you're not working with an income specialist?
How do you know, Dave?
When they have those pesky bond funds and bond
mutual
ETFs
funds
in your portfolio.
No good.
That's one true sign.
Well, a great way to work with an income specialist is to go to our website, actually, retirementincomesource, SOURCE.com. You can actually take a look at all the income specialists across the country and see if maybe there's someone in your area that you would be interested in speaking with. But Dave, it's been a great show. I really hope our listeners and our viewers have enjoyed it. If you like this show or you want to share it with your friends, check out our retirementincomesourceradio.com. That's our website with all of our past podcasts and different shows on there. You can also go to our YouTube channel, Retirement Income Source on YouTube.
Yeah. And please share it with your friends and family. We'd love it if you do so. And more importantly, we're so grateful that you're here with us this week, and hope you join us again next week. I'm David Scranton with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the income.